The stock market isn't crashing, and that's actually the problem. Right now, something is happening beneath the surface of the market that most everyday investors are completely missing, and by the time it becomes obvious, the opportunity will already be gone. Before we get into it, if you're new here, hit that subscribe button right now. I put out one video a week that breaks down how money actually moves in the real world, not the watered-down version they teach you in school. You don't want to miss this one. Okay, let's talk about what's really going on. There's an index called the World Uncertainty Index. It measures how often the word uncertainty shows up in economic reports, central bank statements, corporate earnings calls, and policy documents all around the world. It just hit its highest reading in over 30 years, higher than COVID, higher than the 2008 financial crisis, higher than the weeks after September 11th, and it's not even close. That's not someone's opinion, that's a number. And that number is telling us something very specific. The range of possible outcomes for the global economy right now is wider than it has been at any point in modern history. Professional forecasters can't model it, institutional investors are scrambling, policymakers are guessing, and most regular people like you and me, are either frozen, panicking, or chasing whatever they saw spike on their brokerage app last week. Here's what I want you to understand today. In environments like this one, money doesn't leave the market. It moves inside the market. It rotates out of sectors that are getting hurt by the new environment and into sectors that are built to thrive in it. And that rotation is not random. It follows patterns that have repeated across every major crisis for the last 50 years. Understanding those patterns before the rotation is obvious, before CNBC is covering it, before your neighbor is talking about it. That's the difference between being on the right side of this and watching it happen from the sidelines. So let me give you the full framework. Let me show you exactly what's happening, where the money is going, and what you need to understand to make sense of it. First, I need you to understand why this moment is different. Because most of the commentary you're hearing is treating this like a regular correction. It's not. A normal market downturn is a valuation correction. Growth slows down, earnings estimates get revised, investors get scared, multiples compress, the market drops. Then earnings stabilize, confidence comes back, the market recovers. That's the cycle that's played out over and over since the 1970s. Most investors, even most professional investors, have built their entire mental model around that cycle. What we're in right now is not primarily a valuation correction. It's a structural repricing. Think about what's happening all at once. You've got an active military conflict disrupting one of the most critical oil corridors in the world. You've got tariff-driven trade fragmentation reshaping global supply chains in ways that took decades to build. You've got dollar weakness eroding the purchasing power of dollar-denominated reserves. You've got inflation that keeps proving more persistent than any official forecast expected. And you've got a Federal Reserve that is stuck caught between fighting inflation and avoiding a recession and can't fully commit to either direction. That combination is not a temporary shock that goes away when sentiment improves. These are structural changes to the environment in which businesses operate, in which consumers spend, and in which capital allocates. And that distinction matters enormously for how you invest. In a structural repricing, not all stocks recover at the same pace or to the same degree. The sectors that were priced for the old world, where globalized supply chains, low inflation, low interest rates, and a strong dollar were just assumed, those sectors face a real fundamental reassessment. Not just a panic-driven sell-off, a genuine repricing based on new realities. And the sectors that are built for the new world, where energy security matters, where domestic production is strategically valued, where pricing power is the differentiating characteristic, those sectors face a genuine re-rating upward, not just a temporary spike, but a sustained fundamental upgrade. That is the analytical work that serious institutional investors are doing right now. And most everyday investors are doing the opposite. They're either sitting in cash, paralyzed by uncertainty, or they're chasing whatever already spiked in the initial shock phase without asking whether the fundamental case for that move is actually sustainable. Let me give you the framework that changes that. Every major crisis plays out in three predictable phases. The phase you're in when you act determines whether you're buying into a spike that's about to reverse or into a structural move that's just getting started. Phase one is the shock. This is the first few days to weeks after a major event. Fear dominates. Algorithms amplify volatility. The S&P 500 typically drops 5 to 10% in the first 2 weeks. Gold spikes, oil spikes, defense stocks jump, and retail investors make one of three mistakes. They sell everything and move to cash, locking in losses and guaranteeing they miss the recovery. They freeze completely, doing nothing, while a portfolio built for a different environment keeps getting eroded, or they chase the spikes buying gold at the peak of the fear trade, piling into energy stocks after they've already moved 40%. What are institutions doing in this phase? They're not reacting to price movements. They're analyzing the structural implications of what just happened. They're building watch lists for what comes next. Phase two is repricing. This usually begins 3 to 6 weeks after the initial shock. The market starts asking more sophisticated questions. Not, is this bad? But how long does it last? What are the second-order effects on supply chains? What does this mean for inflation and Fed policy? Which companies can pass through higher costs and which can't? Markets often partially recover from their initial decline as the most extreme fear scenarios get priced out. But underneath that surface-level recovery, something important is happening. Money is flowing between sectors at a pace that doesn't show up in the headline numbers. This is the phase we are in right now, and this is where the framework becomes most practically valuable. Phase three is the rotation. This is where informed investors make serious money and where most people who are still in cash, still frozen, or still holding the wrong sectors from before the crisis miss the opportunity entirely. In the rotation phase, the sectors that are genuinely positioned for the new structural environment see sustained capital inflows that can last quarters, sometimes years. Not because of sentiment, because earnings in those sectors are genuinely improving, while earnings in the wrong sectors are genuinely deteriorating. Capital follows earnings, always, eventually. Let me map this to the specific sectors and the specific dynamics of right now. Energy infrastructure is the first structural winner. And I want to be precise here because there's an obvious trade and a real trade. The obvious trade, buying oil producers when a critical oil corridor gets disrupted that was correct for the first phase, but it's increasingly a bet on geopolitical outcomes that nobody can predict with confidence. The real trade is energy infrastructure, pipelines, storage terminals, refineries, liquefied natural gas processing and export facilities. These assets benefit in two distinct ways. First, directly from higher energy prices, which improve their economics and cash flows. Second, and this is the part most people miss, they benefit from the strategic imperative that this crisis has created. Every major economy in the world is now accelerating investment in domestic energy infrastructure and supply chain diversity. That investment will flow through the balance sheets of the companies that build, operate, and own the physical infrastructure of the energy system. The investment horizon for this thesis isn't weeks, it's years. Defense and aerospace is the second structural winner, but again, there's the obvious trade and the real trade. Defense stocks already spiked 40% or more in the initial shock phase. That move was driven by fear and algorithm-driven buying on the obvious thesis. It was not driven by the fundamental re-rating that's actually occurring in defense sector earnings expectations. The real trade in defense right now is not the headline names everyone already knows. It's the specialized suppliers of components for AI-driven defense systems, drone technology, cybersecurity infrastructure, surveillance and communication systems. Defense spending in the United States is heading toward a budget increase that could approach 50% over the next several years. And that spending does not go to the same companies in the same proportions as prior defense spending cycles. It goes disproportionately to the companies building next-generation capabilities, autonomous systems, directed energy weapons, cyber defense, space-based intelligence. Those companies are not yet household names. Their valuations haven't been adjusted to reflect a sustained, multi-year demand environment. That gap between current valuation and earnings trajectory is where the opportunity lives. Gold miners are the third structural winner. This one deserves a specific explanation because the mechanism is different from owning gold itself. A gold miner's revenue is determined by the gold price. Its costs are largely fixed in the near-term labor, energy, equipment. When gold moves significantly higher, the miner's revenue goes up proportionally. Its costs don't. The operating margin expansion is dramatic. A 25% increase in the gold price can produce a 30 to 40% increase in a miner's operating profit, depending on their specific cost structure. That's operating leverage. And in an environment where gold structural tailwinds, dollar weakness, Fed accommodation risk, central bank accumulation, and a slow global move away from dollar-denominated reserves are as strong as they've been in decades, miners represent a leveraged way to access a thesis that the physical market is already validating in real time. Consumer staples are the fourth structural winner. And I know, not exciting, but hear me out. Companies that sell food, household products, and personal care items, the stuff people buy regardless of how confident they feel about the economy, have two specific characteristics that are extremely valuable right now. First, they have real pricing power. When inflation drives up input costs, they can pass those costs through to consumers because their products are non-discretionary. That's not true of most companies. Second, their earnings don't fall off a cliff when GDP growth slows. They're not cyclical. In a stagflationary environment, high inflation plus slow growth, which is exactly what the OECD and multiple institutional forecasters are now describing as the most likely near-term outcome, consumer staples are one of the very few categories of equity that can deliver positive, real returns. Understanding what to stay away from is just as important as knowing what to own. Consumer discretionary, the companies selling things people want but don't need, faces real fundamental deterioration. When oil is high, when inflation is eating into purchasing power, when mortgage rates are elevated and consumer confidence is low, discretionary spending falls. And because their costs are rising from the same inflation dynamics, their margins get compressed from both sides at once. This is not a sentiment issue. It's an earnings issue. And earnings issues produce sustained underperformance. Airlines are perhaps the most directly exposed sector. Jet fuel is a massive proportion of airline operating costs. When oil is elevated, smaller carriers, without sophisticated hedging programs and strong balance sheets, feel it immediately. And revenue is under pressure at the same time from reduced business travel and cautious consumers, higher costs, lower revenue. That's the definition of earnings compression. Growth technology, the companies whose valuations are most dependent on low interest rates because their earnings are weighted toward the distant future, faces a structural headwind from elevated real yields. This is not a sentiment shift. It's valuation arithmetic. When the risk-free rate of return goes up, the present value of future cash flows goes down, mathematically. The recovery in growth tech that some institutions are expecting for the second half of the year depends critically on a credible path toward Fed rate cuts. That path exists if oil price is moderate enough to let inflation expectations fall. It doesn't exist if the conflict re-escalates and oil goes back to $125 or $150. Let me close on the dollar, because it's the most underappreciated factor in this entire picture for most everyday investors, and the most central to what institutions are doing right now. The dollar index has weakened significantly from its recent highs. The dollar's share of global reserve currencies has fallen from 71% in 2001 to under 58% today. The Wall Street Journal, not exactly an alarmist publication, has described the erosion of the dollar's reserve status as a real structural shift. These are not small developments. The dollar is the pricing denominator for virtually every globally traded commodity and asset. When the dollar weakens, gold goes up in dollar terms. Oil goes up in dollar terms. The foreign earnings of U.S. multinational companies translate into more dollars, and a weakening dollar is a signal that money is flowing out of purely dollar-denominated assets, out of cash, out of U.S. treasuries, out of the default positioning that global capital has held for 50 years, and into hard assets, international equities, and inflation-sensitive assets that maintain purchasing power as the dollar's real value erodes. If you are 100% invested in U.S. stocks, U.S. cash, and U.S. bonds, a sustained dollar weakening is working against you in real terms, even if your nominal returns look stable on paper. The right question to ask. Most investors are asking, will the market go up or down? That is the wrong question. The answer changes every week based on the latest headline, the latest tweet, the latest Fed statement. The right question is, where is the money flowing and why? Money flows follow earnings expectations. Earnings expectations follow structural conditions, oil prices, inflation, Fed policy, dollar direction, and the specific impact of each on each sector's revenue and cost structure. Those structural conditions are changing. The question is whether your portfolio reflects that understanding or whether it still reflects the world as it existed before all of this began. Here's the honest truth. The unthinkable outcome for stocks isn't a crash. Everyone's been talking about a crash for months. The real unthinkable outcome is a sustained multi-year period where the headline index grinds sideways or modestly upward, while beneath the surface, the sectors positioned for the new environment deliver exceptional returns, and the sectors built for the old environment deliver sustained losses. That is the stagflationary equity scenario. That's the scenario where sitting in an index fund and waiting it out leaves you with nominal gains and real losses, while the investors who understood the rotation captured extraordinary returns in exactly the sectors the new environment is rewarding. The patterns are not new, the money flows are not random, the framework exists, and now you have it. All right, if this hit different, do me one favor. Drop a comment below with one thing you're taking away from this video. It could be one of the sectors we talked about, a concept that clicked, or just a question you want me to answer in a future video. I read every comment. If you're not subscribed yet, now is the time. I put out one video a week on exactly this kind of thinking economic cycles, where money actually moves, and how everyday people can build real wealth by understanding the systems that most people never get taught. Hit subscribe, hit the like button if this was worth your time. And next week, we're going to go deep on one of the most misunderstood wealth-building principles Ray Dalio has ever talked about and why almost nobody applies it correctly. You don't want to miss it. I'll see you then.